Well, hello everybody. We're going to go ahead and get started. I'm really excited to see so many people here. This is a outstanding turnout for one of the many workshops that we offer. My name is Mark Lakatos. I'm the Director of Training and Development for California for FirstService Residential. And we are so happy to have you here for Ask the HOA and High Rise Experts workshop. The uncertain future of association insurance. So, this is a really interesting topic, and we've got a subject matter expert on the call with us. But before we get started, I do want to kind of tell you a little bit about FirstService Residential. We are really one of the more premier leading residential property management companies in North America. Our mission is, as you see here, is to deliver exceptional service and solutions that enhance the value of every property and the lifestyle of every resident in the communities we manage. We really do take great pride in the level of service and interaction and strong relationships that we build with the residents that we work with on a daily basis and serve. We understand that your home is one of your largest investments and something that's so important to you, and we take every effort we can to make sure that it's a great experience when we work with our communities. We want to give you a little bit of legal disclaimer. This virtual event is provided for information only and does not constitute legal advice. With that, I would love to turn this call over to our subject matter expert, Jamie George, who is our Vice President of Financial and Insurance Services for FirstService Residential. Go ahead, Jamie.
I handle all things insurance for FirstService Financial, which is a sister company of FirstService Residential. We have 30 licensed agents on staff, and we're here to help our clients with things that are related to insurance. So I have personally had my license for 28 years now, and so I'm just so thankful to be joining you today and happy to have this discussion with you. So some of the things we're going to talk about today is the current state of the insurance market. The market's hardening, and we're experiencing significant challenges in the market. We've had some clients that, we're seeing premiums increase between 15, 30, sometimes more % on their renewals. We have other clients that are being non-renewed. We have some brush zones that are impacting our clients. So those are just a couple of the topics we're going to touch on today, and some questions that we've got. And so hopefully I can bring some insight and help answer some of these questions and some of the things that are going on in the market for us today. I could get the next slide. So some of the questions that we've got is, what should our insurance association cover? What kind of coverages should we be carrying? So the associations, there's 6 coverages that you should carry, or at least consider carrying. Those are general liability, that's going to protect you from third-party liability claims, property damage or bodily injury of others. You should also carry property coverage, which is first-party coverage for association-owned property. And then we should also be carrying directors and officers, which is very important. It's what protects the board against the decisions that they make while governing their community. And then we also have crime or fidelity, which covers against embezzlement. And there is a state statute in the states of California and Nevada that require associations to carry this coverage at the level or limit of 3 months assessments plus full reserve. So that's how you calculate that limit you should be carrying. And then we also have, a couple other policies you should consider are umbrella coverage, which goes above and beyond your liability underlying coverage, and then also work comp. So you should be covering work comp if you have not only your own employees, but it can help you against vendors if they have a lapse in insurance. And depending on the work comp policy that you have in force, it could also give you coverage for volunteers, mainly being your board members or committee members that are out there helping in your association. Another thing, so the right amount of coverages, that's really going to depend on what your association owns and what you have and what you have going on out there. Typical liability as far as underlying general liability is a 1 million per occurrence, a 2 million aggregate. Property is all going to depend on what you own and what your association has as far as property goes. Do you know, again, that's what we call directors and officers in the insurance world. It's primarily a $1 million limit. Your umbrella, if you choose to carry that coverage, is going to vary anywhere from it could be a $1 million umbrella up to a 50 million or 100 million, depending on, if you're a single family or if you're a high rise and what your exposures are. So those can all vary too. And then work comp, that's your standard $1 million limit as well. So then, the other thing we want to talk about here is we're seeing rate increases. Across the board, we're seeing rate increases. We're seeing in liability, we're seeing in property, we're seeing umbrella, we're seeing everything kind of harden and blow up, and there's just so many reasons for this. So liability, we've seen a lot of litigation lately. So a lot of those injury claims turn into litigation, which drives cost up. Property claims, we've seen a tremendous amount of claims. Natural disasters. We've seen this happening for the past 18 to 24 months. So pretty much even before COVID, we started experiencing COVID, and I don't think we've even seen the effects of COVID yet. A lot of these rate increases we're seeing have to do with natural disasters that we've been seeing in the past. So 2017 and 2018 were two of the largest years in insurance claim payout history. We saw things like Hurricane Harvey, Hurricane Irma, and it's not just our local, it's not just our country, it's not just nationally, it's a global issue. Insurance is a global commodity, so that's something that we have to remember. Not only are we seeing these issues in California with wildfires, we're also seeing fires across the world, Australia, etc. So what we need to remember is insurance is a global commodity, that all of the insurance carriers go back and purchase what is called reinsurance. And so that's where we're seeing a lot of this rate too, is in the reinsurance, in that global market. There are probably 5 to 6 reinsurers that handle all the carriers out there. So we're seeing 40 to 60% increases in the reinsurance market, which is why we're seeing that pass down, not only in the property, but on the liability side. With the issues we've seen on the liability side with that litigation I spoke of, we're seeing a lot of things tighten up as far as liability goes. Umbrella policies are getting much harder to place in the marketplace. Some carriers have pulled out altogether. Some have decided that they might have written that $50 million limit, and now the max they're going to offer is a $10 million limit. So when you might have been able to, get a $50 million limit last year for your umbrella, you may be looking at a $10 million umbrella for your renewal that has a 30% increase. And you might be claims free and wondering why that's happening. Well, it's happening because of the state that our market is in, and the state of the insurance industry and all the losses that we've seen in the past 6 years, and we continue to see. As we've all watched this year with Texas and the storm, that's going to have an impact too on, again, not just locally, not just nationally, but globally. So another question we've had is, brush zones, and how do we know if we're located in a brush zone, or how do we know how do we deal with that? How can we overcome that? How can we help combat it? So there's a couple different websites that the state of California has that you can look at and see if you're in a brush zone and look at and see what they are. Brush zones, they look at a couple different things. You know, what is the vegetation in that area? What is the forestry in that area? What is going on in that area? How dense is it? There are a whole bunch of different things that they take into factors when not only the states look and, you know, we come up with the federal mapping of the brush zones, but then another thing we need to realize is that every carrier goes out and looks at the brush zones on their own and comes up with their own internal brush zones that they're going to use. And those are fluctuating all the time. They're taking into account, you know, what the state has done and what the federal has done and the zones that they have made, but they also take into account their own zones and look at their own losses and do their own judgments on whether they're going to write something or whether they're not. I mean, I've had an experience where a carrier wrote something on one side of a highway, but didn't write it on the other side because they felt the other side was a little bit denser, a little bit thicker, just that little bit further away from the fire hydrant or the fire department, and they weren't as comfortable with it.
So we do have one question. I know you started to elaborate on it a little bit, but I think it might be good for the group to hear sort of a clear definition of what is a brush zone. I mean, I know, again, you kind of alluded to it, but just to sort of define that.
So a brush zone it's somewhat hard to define, Mark, but the brush zone it all comes down to the vegetation, the trees, the density, how far they are. A lot of factors come into brush zone. It's not just you can look at it and go, well, that looks like a brush zone. Again, it comes down to the forestry in there, the bushes in there, the density of that vegetation. And it comes down to factors like, where's the fire hydrant? Where's the fire department? And how long is it going to take to get help there? There's a lot of different factors that go into these things than just looking at it and saying, well, that looks a little denser than across the street.
Got it. You know, for homeowners that live in sort of wildfire zones, what options do they have? Is there anything that, you know, they can do?
So it's really hard because, you know, again, we have not only federal, but we have state doing these brush zones, but we also have carriers doing it. So what I tell our clients and what I tell homeowners is, you know, if you can cut that vegetation back, that's going to help you. I don't know if it's going to help bring your rates down, but it's going to help you in the event of a wildfire. If you've cut your vegetation back from your structure another 10 feet, that's going to help your structure.
Is there anything that, I mean, beyond, you know, cutting back the vegetation, that in relation to, you know, working with insurance carriers that they should be aware of? And, you know, are there certain things that they're looking for that maybe they should be focused on?
So I'll share some things I've heard in the industry. They haven't come over to the commercial side yet, but I've heard on the personal line side in California, they are starting to take into account if homeowners, you know, cut that vegetation back into what line it's been cut back, and they're starting to take into account some proof of that. You know, take those photos and show how far back that vegetation line is, and maybe they'll take into account and give you a little bit of break on your premium. That has not flowed over into our commercial side, which is where our associations fall, but I'm hoping that maybe it does soon. At this point, it really hasn't. But I also know there's some other carriers out there, depending on who they are, but they may also offer some discounts if you have some things done to your building, like fire retardant sprayed on it, things of that nature. But those are things that you would need to discuss with your individual carrier and what they offered for you doing those things.
Good, good, thank you. And if you have other questions, folks on the line, if you have any questions, feel free to type them in the chat box. We have producers monitoring the chat box, and they will help to feed me the questions, and we can make sure Jamie gets a chance to answer them for you. So please do. I think we're go on to the next slide, I think.
Okay, so looks like these are some great questions. Let's handle this first one here. How does the HOA decide on and navigate the deductible for major water damage? It appears that there is a huge gap in which HOA insurance will cover and what the homeowner's insurance will cover. So this can kind of be a tricky question to you. I know I keep kind of saying that or repeating myself there, but unfortunately, insurance is always gray. It's never like a black and white kind of situation. It's always gray. So, how do you navigate your deductible for water? So that's another thing we're seeing. Not only are we seeing these rate increases, but we're seeing underwriting tightening. And one of those things we're seeing, especially in the condo or HOA world, is you might have your carrier offer you a renewal, but they might be offering you a higher water deductible. We're seeing water deductibles largely increase. So they're doing that to try and bring loss down. So, some of you might not have an option of what your water deductible is, although I can see, I've started to see it in the marketplace, some buy downs being offered, like where you can buy that down. If your only option is 50,000, you can buy a buy down policy and buy it back down to 20 or 10. But a way that you can overcome it is in my opinion is to educate your homeowners. So again, depending on your CCNRs and what they say, who's going to be responsible for that deductible, it might be the association, it might be the negligent homeowner, or the association might have the right to go back and assess the homeowners that deductible. So the homeowners can carry on their homeowners policy on their HO6, there is loss assessment coverage that they can carry that will help them, if they get assessed part of that deductible or it goes back to the homeowners, or if they're negligent, that will give them coverage for that. So it's, in my opinion, it's very important that the homeowners have a conversation with their personal lines homeowners insurance, and that they share not only, what kind of coverage the association master is carrying and what deductible they have, but they also share a copy of the governing documents with their agent so that their agent can read those and understand when their clients might be responsible for those deductibles. So it helps to cover that gap when you have your homeowners with the proper coverage.
One thing, I know there's some other questions here too, but I've heard come up before, specifically around liabilities and insurance with playgrounds. I know there's been some cases that we've read about with other management companies where that's been a big deal. I wondered if you had any insight there.
I do. So, again, hate to be the bearer of the bad news or shut the sun down, but it is always my recommendation that if you have some sort of playground, play structure, tot lot, whatever term we want to use for it, you really want to consider carrying an umbrella, which is a policy that goes over and above, we mentioned it, your liability. So when your underlying limits are exhausted, your umbrella kicks in. So, I'll give you an example. I've actually heard a horror story in Las Vegas about a swing set that wasn't properly maintained. So it needed to have maintenance. That the board had it inspected. It needed to have maintenance. They were told such, for whatever reason, they decided that they didn't want to do the maintenance. And they made that conscious decision in a board meeting to not do the maintenance. They also didn't have the play structure removed that needed to have the maintenance, which, in my opinion, would have been another option if you didn't want to do the maintenance on it, than to remove the structure. They left the structure there with no maintenance. And then we fast forward, it was about 6 or 8 months later, there was a teen sitting on the swing and the upper bar collapsed. He was, looking down at his phone and text messaging, and the upper bar collapsed, struck him in the head, and he is now in a vegetative state. It has gone all the way through the Supreme Courts in the state of Nevada, and the judgment against the association is $20 million. They had an, underlying liability policy for $1 million, and they were not carrying any umbrella coverage. So I don't know if they were self-managed. I do know that we did not manage them at the time, but it's unfortunate. It's unfortunate not only for the injured party, but it's unfortunate for the association and the homeowners in that community now that have a $19 million deficit on a lawsuit. So, I mean, it's very important that you have conversations with your insurance broker. And, if your management team has an insurance department like we do, have a discussion with them about, maybe what some of your exposures might be and what you need to think about your liabilities and exposures are. But my advice has always been, Mark, if you have a tot lot, if you have any sort of playground, any sort of fun, you should be carrying some sort of umbrella.
One of the other questions that I saw come in was related to earthquake insurance and which community should be carrying it.
So earthquake is a very difficult subject. It's a very expensive coverage to have. And I can tell you that out of all of our clients in the state of California, only 8% carry earthquake coverage because it's so expensive. But I guess one thing that everybody needs to realize that is earthquake is not a covered peril under your property coverage. It is excluded. You do need to have a separate policy for earthquake. There are some other options out there other than, the master association carrying earthquake. Not only can homeowners get a quote, but there's a fairly new product by a company called Modus that's it's unique in its offering. Some of our broker partners offer it, and some very limited brokers throughout California offer it as well. But and I won't get into too much detail, but it's another good avenue that associations can explore to get that coverage without buying that very expensive master. But I do think depending on where they're, situated, we have some areas that are more prone than others, it could be something to consider.
One of the other questions that came in is related to some of our mid-rise, high-rise, communities or those that live in those. Are there any, safety precautions or things that they can put in place from a preparedness perspective that might give them some discounts?
So there are some carriers out there that offer, and some of them anymore are getting to the point where they require it, automatic shutoff valves, gas shutoff valves. There's some different things like that that can be done where they will give some discounts.
Then the last question, because I know there's some more questions on the slide, is if they execute recommendations by a fire marshal or a forester, if they come by for those defensible sort of space inspections, does that sometimes translate into premium discounts?
Sometimes it can. You're going to have to check with your individual carrier. I mean, on the fire brush side, I don't see the carriers have advanced like I was talking about earlier on the commercial side where they're offering that discount yet, but I have heard it just start on the personal line. So I'm hoping it trickles over, hopefully sooner than later, to the commercial side.
Okay. There's some good questions coming in. I'll pause and let you get those ones on the slide there.
Okay, so let's see. Can I discuss specialty markets for golf course liability? This is a very specialty market. I know of 2 carriers that write it. So I'm not going to spend a whole lot of time on that. It is a specialty market. It's very hard coverage to place, and that would be something you need to talk to your broker about placing for you. Let's see, what else do we have? This is a good one. What are some current best practices for HOA with pools regarding COVID and liability exclusions, pathogenic agents, and communicable disease? So I guess the statement I will make here, Mark, is that we'll be very clear. There is not insurance coverage for COVID-19. Communicable disease is excluded. So if it wasn't excluded, which 95% of the carriers excluded it prior to COVID-19 already, they had that exclusion. And I can guarantee you now, they have it. Your new renewal, if you were the one that the small percentage that the carrier had it before, they don't now. It's been excluded. I haven't ran into a carrier yet that's covering communicable disease. How to handle a situation where the washing machine overflows, damaging the units below it in the stack. This is, again, is kind of a hard one for me to answer. Your CC&Rs are going to guide you along these lines. The California Condo Act says that the insurance master is going to be primary and it's going to cover up to the bare walls, but your CC&Rs are going to dictate negligence and that sort of thing, and what is covered beyond those bare walls, whether it's to originally built specifications or whether it includes the improvements and betterments. It's also going to tell you whether you can collect your deductible back from the negligent party, and if there's any subrogation rights for the Masters Association insurance to go back to that unit owner's insurance. So this one, you're basically going to refer to your CC&Rs, and some of them even say it's going to be, unit to unit depending on the damage. So CC&Rs are really going to dictate here what happens, how it's handled, and how it can be handled, and who's responsible.
I'll throw in a couple more questions from the, I'll throw in a couple more questions that we got online. What type of incidents need to be reported to insurance carriers?
Okay, so that's a super broad question. So let's break it down a little bit, because depending on what kind of incident you're talking about could jeopardize your coverage or not. So let's go to an incident. First, let's hit on like a GL example, general liability. Someone slipped and fell on the property, and they slipped and fell and they're injured. You're going to want to report that. They have 2 years to file a lawsuit. You're just going to want to put the carrier on notice that happened on the property, and sooner the better, because you're going to have the more details from the manager or whoever witnessed it. It's just going to be fresher, and you can get that on record and just have it sit there. It might end up being closed if they never make a claim, but at least the details are on record. Property, you're going to want to judge by what is my deductible and what is my damage. So if you're a condo and you have a $25,000 deductible and you know that the damages are $8,000, you're not going to report that to the carrier. You're going to keep it off your loss runs. You're not going to tell them about it, and you're going to take care of it because it's under your deductible. If it's close to your deductible and you think it's close to your deductible, you're going to kind of play that little game of, let me get my estimates and see how close I am. Again, if I have a $25,000 deductible and my damage is $26,000, I'm not going to report that claim. I don't want that on my loss runs to claim $1,000 that they're going to pay me. Now, if you have a huge fire and there's no doubt about how much damage there is and you're over your deductible, you're going to report it right away. So then let's move on to directors and officers, because this one, Mark, it can get kind of sticky. So directors and officers, they have a clause in the policy that says you need to report anything in writing within 90 days. So if you get a threat of litigation, so let's say you have something going back and forth with a homeowner, with the board, or a manager, and they get to the point where they say, you know what, I'm getting tired of this, I'm going to get my attorney involved, and they threaten you with the attorney. Even though you don't think they'll ever get the attorney because you've been going back and forth with them for a while here, you can't assume they're never going to get the attorney. You need to start reporting that to the carrier, because of that clause that's in there, anything in writing of a threat needs to be reported to the carrier within 90 days of receiving such threat, or you will jeopardize your coverage. So you can put your carrier on notice and nothing could ever come of it. And then that's what your agent's going to tell the carrier when it comes up for renewal. Well, nothing came of that. They put the carrier on notice trying to protect their coverage. But I can tell you this, 6 months down the line, if they go out and they hire an attorney and they file a lawsuit, you've protected your coverage. If you didn't notify your carrier of that and then just tried to turn it in when you got the lawsuit 6 months later, your carrier would come back to you after they have gathered all the information, because that's what they're going to do, and they're going to look into it and they're going to say, you knew they were going to hire an attorney 6 months ago and you didn't tell us about it.
Yeah, well said. With you were talking earlier about earthquake insurance and how expensive it is, and one of the questions that came in is what your thoughts are regarding if an HOA doesn't carry earthquake insurance, and should the individual homeowners consider it?
I do think they should consider it. So I mean, on a personal level, I understand why associations don't carry it. Sometimes it's just not in the budget. It is very, very expensive, and it also comes with a very large deductible attached to it. It's a 5 or 10% deductible. of your total insured value. So, you know, if you're carrying 10 million in earthquake coverage with a 10% deductible, it's $1 million that you got to come up with before your coverage even kicks in. So I do recommend that the homeowners carry their own coverage, because that might be where your coverage is coming from in the event of an earthquake, when your master doesn't have it or couldn't afford it.
One of this is kind of a detailed question, so I'm going to just sort of read it as is. It says,
Okay.
we have an indemnification forms for use on the tennis court. We know there is no coverage for COVID-19, and we know the owners feel it is overkill. Do these forms make any difference from an insurance standpoint?
I mean, I always say that getting the liability signed is a good idea. It's never a bad idea. But at the end of the day, it can also be what I like to call a false sense of security. You know, you think because you got the waiver signed that you're completely protected. And, you know, I'll be honest with you, depending on the situation and the allegations in court, it may or may not do you any good. So I know I'm being very vague, Mark, but it's really the board's decision whether they want to, you know, push that indemnification or not. And, you know, it might do them good if it came to court, and it might not. So I can't give us, I'm not going to, you know, really give a solid answer, because it has to be the board's decision and what makes them comfortable.
If this question's back to sort of the idea of fitness centers and pools and COVID, is there any liability issues that HOAs may have in relation to those, like reopening?
So what I always say is, you know, you have to follow the state, local, and federal CDC guidelines. Do you have liability opening? You know, Mark, I unfortunately can't answer that question. I guess everyone could always make an allegation, right? That they contracted COVID-19 at the pool or in the fitness center or whatever the case may be. But, you know, you always have to go back to how are they going to prove that? How is that going to be proven? Now, I can't answer whether you could prove it or not. I have my own individual thoughts that, you know, I won't share here, but it's going to be the board's decision on whether they want to take that risk or not. But what we do need to know is there's no coverage for COVID-19 or communicable diseases.
Yeah. I know they're pulling in a few other questions, so this will be a great chance for you to get these last few on the slide.
Okay, so I think I'm down to the last one. And what impact do ongoing HOA lawsuits have on HOA insurance rates and insurability? So I thought this was a great question too, because I can tell you this, your loss runs, whatever loss you have, whether it's liability, property, whatever the case may be, it's going to stay on your loss runs for 5 years. Carriers look at a 5-year loss history. So, you know, let's break this down a little bit. If you have an ongoing, you know, I'm reading the question exactly as it's stated to me. If we have an ongoing HOA lawsuit, so to me that states open lawsuit, still ongoing. If you have any sort of open claim on your loss run, whether it's general liability or D&O, you know, related to the liability portions of your coverage, that makes carriers very nervous. Open claims, carriers don't like to look at it. You're probably going to be staying with your current carrier. And, you know, I don't want to be the negative Nelly or anything, but hoping that they offer you a renewal, depending on what your ongoing lawsuit is and what the allegations are and how it's going.
Yeah.
And then after that closes, again, it's going to affect you and stay on that lawsuit, on those loss runs for 5 years. So, you know, the closer you can keep your agent to that claim and what the circumstances were around it and whether you won or lost that case, you know, a good agent's going to go to bat for you at renewal and have those discussions with the carrier of, yes, they had the lawsuit, but it was dismissed and this is what happened. And, you know, because just because you're in a lawsuit doesn't mean you're guilty either. Anyone can always make allegations and you have to defend yourself.
Yeah. This is a good question that I thought was interesting. I don't know if it may even lead into some of our FFI options as well. You know, what steps can the HOAs take with their budget to mitigate some of these 15 to 30% insurance increases?
So some of the other things to think about is just, all I can really say is we can, we're mitigating as much as we can. We're out there shopping the market, trying to get the best rates we can, but make sure you have the proper coverage, so make sure that your property limits are right, that you're not over insuring. You don't want to under insure either to try and save money, but make sure your limits are right and that you're not overshoring on property by $1 million or $2 million. You can cut your limits that way. Another thing to really look at, Mark, would be your deductibles. I see some people that are carrying $1,000 deductibles on their property and have been for the past 20 years, because 20 years ago you could carry $1,000 deductible. Nowadays, especially in the condo realm, you should be looking at 5, 10, or 25, a larger deductible to bring those premiums down.
Yeah, that's good insight there too. You mentioned earlier when you were talking about water coverage, and one of the questions that came up was, are you including flood insurance in that category when you talk about water coverage?
No, flood is a completely separate policy. So natural flood, Mother Nature, mudslide, things of that, completely separate policy. So, water loss is covered if it's, sudden and accidental loss of, from your pipes or something of that nature inside, that's covered. But if you're talking a flood from nature outside, that is a completely separate policy, just like earthquake is. Earthquake's never covered under your property policy. So I guess with that being said, Mark, one thing I'd like to just throw out is this is one of the advantages you can really have of having an agent that, their expertise is in the HOA condo space. The associations have a lot of needs that not every agent's going to understand. So that's why it's really important to work with an agent that understands the needs of associations and condos and, directors and officers and the different caveats that it holds and what you need, within that and umbrellas.
Yeah.
Earthquake and flood and the fact and telling you these things that they're not included in your regular policies. And that's why it's really important to work with an agent that specializes in this space.
Definitely a lot to think about. Here's another question that I thought was a really good one. It's a little long again, so I'm going to read it as is. It says, you mentioned $1 million general liability per occurrence as normal. It seems to me that $1 million is no longer that much. Do you foresee, or has there been any conversations around increasing that minimum limit?
So that minimum limit is what I see on the general liability a lot. It'll be a 1 million per occurrence, 2 million aggregate, which that's the most they'll pay out per occurrence is $1 million. The most in a policy year is the 2 million. But this is where the umbrella can come into play. Purchasing an umbrella, if and when those underlying limits are exhausted, then that umbrella kicks in for those liability limits. So that's why I say I really suggest, if you have any sort of, and this is just my way of making it easy to remember, Mark, any sort of fun, tot lot, water, anything you're doing that's fun, you should probably think about carrying an umbrella. And then depending on the level of fun you're having, what limits maybe you should consider having.
In relation to condos or high rises, if the homeowner doesn't carry enough insurance for inner damages that occur, especially like leaking down to other units, does the HOA insurance take over then? Are they sort of the secondary coverage?
So that's kind of a hard question to answer. So it leaked down. What did the CC&R say? Was it responsibility of unit to unit? And then the upper unit didn't have insurance? If that's the case, then that lower unit's going to go to their insurance carrier. Again, in a unit to unit situation where the HOA might not have been involved. Because again, every set of CC&Rs is different. And it can break down to, if the pipe services 1 unit or 2 units, or if it's a main pipe, or if it's this. So in this scenario, I'm going to go with the assumption of we had 1 pipe that served these 2 units, and CC&Rs told us that it was a unit to unit situation and where our association was not involved. In that case, if that upper unit didn't have their own homeowner insurance to cover their liability for the down below, then that down below unit would go to their insurance carrier, get their damages repaired, and then their carrier would go subrogate against that upper owner.
Got it. You mentioned earlier that that's why it's good to have, a broker that has experience with HOAs. What would you say some of the risks are associated with working with a broker that doesn't have that experience?
Oh my goodness. So, there's a lot of risk. So, there can be things they might not just understand, associations and nonprofit and board of directors and D&O. So I've seen some with D&O policies that I'll just throw out some things really quick. Defense can be inside or outside your limit. That can be a big deal. Another thing can be whether it includes employment practice liability coverage for third party. So that can be a big deal. Another thing can be, does it have full prior acts or a retroactive date back to inception? Or is that retroactive date today, the day you're binding it, which essentially gives up all your coverage? And there are some agents out there that aren't versed in directors and officers and nonprofit associations, and they don't understand when they're writing that coverage. Not only do they not understand what they're covering for, they don't understand what their clients could be giving up when they write it with the forms that they have to write it on.
Yeah. It's so, as I listen to you, Jamie, it just sounds so complex, right? So if I'm on a board, there's just a lot of questions, a lot of things that I'm sure I would have. One of the questions that came through was, who should the HR board meet with to convey community needs, or to even just discuss what the right coverage is? Is it us, or the carrier? Who should they be talking to?
So it's a couple different things. I mean, it's your broker, number one, but the boards also have a responsibility too, Mark. It's on them to provide their broker with proper information about their risk, about their property. So it's important that boards and associations have, reserve study if you're a single family HOA or something of that nature, or a condo, or an appraisal if you're a high rise or a mid rise, or those are the tools that your brokers can use to help make sure that they're insuring you properly. But at the end of the day too, it's the responsibility of the board that they're getting the proper information to the broker, because the broker's only going to know so much of what you have. We can go out and walk properties, but we still can't see all the property that you own. So that's why we use all these other tools of budgets and financials and reserve studies and appraisals. We take it all and into consideration, and then the board has a duty too, that when they look at those, when you're looking at your proposals or your renewals, to keep an eye out for your property values and different things, and to let your agent know, well, in the last year we added a security system that was $100,000. Did we tell our broker about that? Do we need to up our property coverage because we added that? Because, your broker's not going to know that unless you tell them, or unless you give them a new reserve study and they can see, oh, wow, they have a security system now.
We got one more time for one more question, and I thought it was a really good one to kind of wrap up on, because it's unique. HOAs that have volunteers. So they have this one question that came in, they have a separate policy that covers their volunteers, but they were only able to find one carrier that would do that. One, they want to know, does that sound right? And then do we have any suggestions on how to find different options for volunteer coverage?
Sure. So there's a couple different ways you can cover your volunteers. There isn't a volunteer accident coverage. I think it provides $25,000 per volunteer, and I can't remember how much it is, $400 or $500. But there's also some work comp carriers out there that will write a policy. It's called an if any work comp policy, but it also has an endorsement on it for volunteer coverage. So that's where you can get the coverage for your volunteers. And it's not just that $25,000, it'll be that $1 million limit. It'll cover them for, not for any wages that they lost because they're a volunteer, but it'll cover their medical expenses if they're injured. So I've had that come into play a couple times, Mark, if you want me to throw out a real quick example. I had one board member fell off a ladder and punctured his lung, and had $250,000 in medical bills that it covered for him, and it picked up his co-pays, and it picked up his prescriptions. And now again, it didn't cover his wages because he was volunteering, but it picked up all those co-pay costs that would have been a lot of out-of-pocket expenses. And then I had another one where it was an association hosting a pancake breakfast for the neighborhood, and cooking pancakes for everybody, no charge, just come have pancakes. And one of the volunteers burnt her arm on the griddle. It was a pretty bad burn too, and so she had to have some medical attention, and her bills weren't astronomical, but they were paid through this work comp coverage.
Now,
and again, no pays for her. No, she was just trying to cook pancakes, and help out. So
that was, I love those examples. Those are good examples. So, Jamie, first of all, I want to say thank you so much for taking time to, spend with the community, answer some of the great questions that came in. If you want to switch to the next slide, we have some information, some contact information that we have up there. But if you feel like you didn't get your question, we didn't get to your question, we tried to get to as many of them as we possibly could. We do have your question, and we'll be able to get back to you. We'll work with the management teams to get your questions answered, of course. But if you want to learn more about FirstService Residential, you can certainly visit us at fsresidential.com. You can also learn more about our financial services and some of the things that Jamie talked about and how we as brokers can help you at FirstServiceFinancial.com. And then, of course, there are some articles and best practices that you'll have access to that we'll be sending those out, so you have them for whether you live in Arizona, California, Nevada. We'll have those available so that you'll be able to see those. And again, FirstService Residential, as a premier community management company, loves serving the community. We love working with people, even if you're not one of our clients that we work with. We're glad that you were able to be here with us, and we're glad that and hope that you found this valuable and useful. So again, if you have any questions or need any additional information, you'll have an opportunity to reach out to the folks that arranged this. And so again, Jamie, I want to thank you so much for your time. And I wish everyone on the call also a pleasant and wonderful afternoon.